Well, good afternoon, everyone. And once again, happy Cannabis Month, October 2022. And welcome to the Core Summit Cannabis Empowering Growth. I hope you've been enjoying the last couple of days. And I know that actually it's been the entire month of filled information in the cannabis sector, the event with our partners, ArcView Capital in New York, once again exploring what can cannabis companies do. And as you heard some of our great speakers in the last couple of days, we've been talking about how to get started. What are the things that are very unique within the cannabis sector that people need to consider before they even jump on board to the legals? But as well, on the second day, we ended up talking about how to build a community, how to get like-minded individuals to then participate in the growth of your business, but not only participate as customers or partners, but also to engage them, to have them become investors in your company. So it's been a great journey the last few days. And today it's the real, now you've gone through the beginning. Now you know, you're getting all excited. Now you need to meet the experts. And as we all know, cannabis is a hot topic in North America. Why? Because in Canada, it's legal. That's right, coast to coast. From one end to the other, you can sell it, promote it, and so on. And we have a great speaker to that event, Nauth, who's going to be here today, representing both U.S. and Canada, a very unique securities lawyer that is going to bring that awareness and discussion, as well by our friend and colleague who have been there right from the beginning of the Jobs Act, Sara Hanks, who is going to obviously bring her vast experience in regulation CF, regulation A+, and of course there's other regulations, but these are the prominent ones now that we are alerting the cannabis sector to be involved with. Moderating today's panel is our Chief Revenue Officer, Peter Daneyko, who's going to kick it off with this great panel. And again, this is a journey that you need to undergo. In each of these days, you're going to learn something new, and today is the legals. Yes, you have to go through it because you can't get through until you go. Enjoy and have a fun time. Peter, floor is yours.
Hey, thanks, Oscar. So as Oscar indicated, I mean, we have a very rich panel today. Waiting for Daniel to jump on here. And Sara, welcome. I'd like to go around the table quickly as we wait for Daniel. And Daniel, great to see you here. And we're looking for Canadian and U.S. perspective. It's, as Oscar had indicated, it's rare that we have a breadth and wealth of knowledge specific to a regulation that's been around for a long, long time, but it's just in the last couple of years that's really exploded for a number of reasons. And maybe I can have Sara and Daniel. I'll start with you, Sara. Just give the our audience and our viewers a little bit of background on Sara Hanks and CrowdChecks. You're known to most of us in the industry, but we got a lot of new guests here watching. So,
okay. Oh, thanks for the intro. Sara Hanks. I'm CEO of CrowdCheck and managing partner of CrowdCheck Law. And together, the two of them provide a wide range of legal disclosure, diligence, and compliance services for all of the online securities exemptions, Regulation A, Regulation CF, Regulation D 506C. And think of us as a law firm plus. I'm a former SEC staffer, so I speak their language. And we have done a whole host of Reg A offerings, Reg CF offerings, Reg D offerings, including with cannabis, which has its own very special tweaks and twerks.
Well, that's an area that we're going to talk a lot about today as far as the cannabis tweaks. Daniel, give us, it's a pleasure to meet you again. Give us an overview on your firm.
Really interesting. I actually started off as a Canadian securities lawyer at a large Bay Street firm here in Toronto, practicing primarily corporate securities transactions, M&A. Ended up moving to New York, worked on Wall Street at a large Wall Street firm for a long time, again, practicing U.S. corporate securities laws. That's where I got my New York call. Was there for many, many years, came back to Toronto and decided to start my own U.S. corporate securities practice, assisting Canadian public companies, for the most part, going public in the U.S., either NASDAQ, NYSE, M&A transactions, equity, debt, finance. And so that's largely where you find me sitting in Toronto, practicing primarily U.S. corporate securities, but advising and assisting Canadian companies.
Excellent. So decades of experience. The regulation Reg A Plus and Reg CF has been around for 10 years now, as of, I think, in March. But it's really in the last 4 or 5 years that it's really taken off. Maybe if I can jump over to both of you, and I'll start with Sara. I think for our audience, give us an overview what Regulation A Plus is all about, what Regulation CF is all about, and then we'll dovetail into. I'll let you start there.
Okay. Well, actually, starting point is kind of interesting in that Reg A has actually been around since 1938. It's even older than I am. But for many years, it was very, very limited. For a start, there were offering size limits, $1 million, and then later $5 million. And as well as going through the SEC, you had to go through the state regulators. And that's why nobody used it. So right up to about 2015, there was maybe one tiny Reg A offering a month for small loser companies, and nobody was using it. And then, pursuant to the Jobs Act, the SEC completely revised it, and that's when it started to get the nickname Regulation A Plus, because everybody thought it was A Plus, I guess. And now it is one of the major exemptions from registration. So just stepping back a sec. If you are going to do an offering in the United States, sell securities in the US, your offering has to either be registered with the SEC, like an IPO, or fit within an available exemption. And so the exemptions, the main exemptions are Regulation A, Regulation CF, and then also for accredited investors only, Regulation D, Rule 506C, which is the online version of Reg D. So Reg A can be an offering of up to $75 million a year, calculated on a rolling basis, so you can do 75 million every single year. It is for US and Canadian companies only. You do have to go through the SEC review process, which I'm sure we're going to get into in detail. But it's an exempt offering, so it doesn't have all of the burden of the ongoing reporting that you would if you were doing an IPO. We can get into the ongoing reporting later as well. Reg CF, the baby sister, maybe, of Reg A, offerings up to $5 million a year, again calculated on a rolling monthly basis. You still have to file with the SEC, but you do not get reviewed by the SEC, which makes it A, much easier, and B, leads to a great deal of non-compliance. And we can talk about that in a bit too.
Well, I've got some big notes on the review process and non-compliance now. Let me throw something at Daniel. So Sara gave us the overview on a Reg CF and a Reg A. We got I can raise $5 million on my CF. There's a lot of confusion out there between I'm a Canadian company and I'm a US company, and I know that a Reg A can be utilized for both types of firms. But how does that? What's the flavor when it comes to the CF side of things? And what's been your experience on that for companies that are looking? First, let's just start with the CF. Let's start with the baby sister.
Yeah, sure. So it's interesting, right? I get a lot of people coming and asking, hey, we don't think we're ready to do a Reg A. Part of it is with raising capital, given the markets, they may say, hey, we want to do kind of 10, 15, 20, maybe, whatever the number is. If they don't raise that amount or some lesser amount, it looks like a failed offering and maybe something's wrong with the company and they don't want those optics. So they say, hey, let's try Reg CF. Just to touch on Sarah's point, yes, it's up to 5 million, but you can actually raise up to just north of $1 million if you don't have audited financials, which sometimes is a good stepping stone. Companies will raise $1 million and then get their financials audited and raise the balance. So the interesting thing is Reg A is available to both Canadian and US incorporated entities. Reg CF is available only to US domestic companies. On the Canadian side, Canada and the US, we see a lot of companies, or I end up seeing a lot of companies that are Canadian incorporated. They restructure to put a US topco on top for purposes of doing a Reg CF and then moving to a Reg A. The real trouble comes in where, and with those companies, you'll have a Canadian or US company, they'll have business in North America, typically, whether it's Canada or the US. The real problem I see is when I have sort of non-Canadian or US companies coming and saying, hey, we want to utilize a Reg CF, we want to raise some capital in the US, can't we just put a US top co on top? And the real problem there is the SEC looks through and says, hey, your business really isn't in North America, you're just kind of creating a shell entity for purposes of the capital raising. So if you're a Canadian or US company, you're pretty well situated. You know, if you want to go Reg CF to Reg A, that's fine. I think the danger is if you're outside of kind of North America and think you want to use a Reg CF or a Reg A, it's necessarily not going to work.
So you brought up a really, really good point there. And Sarah, with your SEC background, maybe you can so I've heard a lot of mixed stories out there. Somebody says, and Daniel, you kind of touched on it, said, hey, why don't I just set up a Delaware Corp and I happen to be a Canadian corporation or a foreign company and I'm going to have a US presence, but it's got to be a little bit more of that. What does that really mean from an operational perspective? Can you give us any guidance on that, Sarah?
Yeah, I mean, you can create a subsidiary, but it's got to be a genuine subsidiary. I mean, as Daniel was saying, you can't just say, hey, well, you know, we're setting this up to be a finance sub. Can't do that at all. One of the things that we see, and I mentioned earlier, that the lack of compliance in this area, what we have seen in some cases is a company that is not eligible to use Reg CF for whatever reason, maybe it's an investment company or something like that, use one of its affiliates and then send the money over there to the non-eligible company. Absolutely not permitted. Haven't seen the SEC sue anybody for doing this yet. I wish I did, because then it would be easier to explain to our clients, no, you can't do that. But really, the money raised under Reg CF has got to stop with the US company and be used for its purposes. Otherwise, if it's going to another company, or if it's the sub is completely reliant on the other company for its revenues, then that other company is a co-issuer, which is non-eligible, and now you've just blown the entire exemption. So I wish we would see a bit more discipline here. I think we have to rely on the intermediaries, the platforms, to really filter people who want to do this and prevent them doing it.
So I've also heard that the repercussions of that can be quite significant if you want to transition from a Reg CF to a Reg A, which we'll get into, which is a really good process, I think. So tell me if I'm correct, either one of you. So if I'm doing a CF and I because it's not a qualified offering and it's not under the scrutiny of to the degree that a Reg A plus is or Reg A is, you know, with the SEC. So it's easier for me to file, I understand, correct? Like I can file my Reg C, but
Yep.
Let's suppose I filed it and I didn't, and I was a little bit untoward as far as my US operation of a CF. And then I go to do a Reg A. That's when everything hits the fan, so to speak. Would that be an accurate statement?
Yeah, that would. I mean, that's something that we see quite frequently. Is a company has, I love the polite Canadian way you said that, a little bit untoward. We see companies who have not complied with the regs in their previous filing, and the only way you're going to get around that is to do a rescission offer. And a rescission offer is you offer to give the money back with interest. Of course, nobody wants to do that. And so you could not go on to do a Reg A. If you've clearly messed up the previous offering, you can't go on to do a Reg A unless you say, we have screwed this up. I mean, you don't want to give a roadmap to everybody to sue you, but that's basically what it is. We did this previous offering. We completely screwed it up. The only remedy here is to give the money back with interest, and you put that as a risk factor. Of course, the first thing the SEC sees when they see the filing is, oh, well, that's interesting. Are you planning to do a rescission offer? And so, yeah, clean up your Reg CFs before you even go into the SEC, because they're going to make you clean it up themselves.
Go ahead, Dan.
Sorry, Peter, just for the audience, if just to sort of clarify for the point of, like, the investors would say, well, how's the SEC going to know? I mean, you're going to spend a bunch of time and costs getting audited financials, preparing a 1A to submit with the SEC, and they're just going to come back and hammer you with the very point Sarah made. So It's not as if, oh my God, we did a Reg CF, let's do a rescission offer. I mean, oftentimes these issuers don't find out about it until they've gone through a whole bunch of costs to get the 1A filed, and then it's, oh my God, we've got to rescind all these prior investments. So, just from a cost perspective, it's also a bad idea.
Yeah. So if you're going to run your business and especially look for multiple raises, and you're looking for a long-term business, it sounds like do it right up front. I mean, measure twice and get proper legal counsel on how to do that. And this is why you guys are both here. So tell me a little about, okay, there's terms that are thrown out there. They're saying, okay, I've got a form C, a qualified, I'm going to go through a Reg A offering, and I've got a qualified offering, and I have different documentation. Hey, if I can raise $75 million, why don't I just do a Reg A? Why do I even want to do a CF for $5 million? What? And I think the obvious one is expense, but maybe you guys can give me that and go from there.
Yeah, well, the expense is certainly a lot more for Reg A because there are a lot of the platforms with Reg CF say, oh, you don't need lawyers for that. You can use our standard documentation, and technically you don't. Technically, you can do it yourself if you think that you can answer all of the questions and you understand what the SEC means by describe the development of your financial situation over the last year. Okay, fine. So in theory, you can do this without a lawyer. Obviously, as a lawyer, I'm not going to recommend that. But for Reg A, you can't. You really can't. And in many cases, we've taken over several offerings over the years that were done in-house by companies who got through several rounds of comments with the SEC, only to decide, oh, look, we can't do this without lawyers. So you've got legal costs. You've got accounting costs, although those are not going to be hugely different between the two. As Daniel mentioned, you've got layers in Reg CF. So up to somewhere in the 600 range. They just did the inflation adjustment. So in the 600 thereabouts range, up to that, you could do reviewed only. And if it is your first time through the process, you can go, as he said, up to 1.24 million with reviewed financials only. Anything above that, you're going to need audited financials. For Reg A, you always need audited financials. Although what we found for early stage companies, there's not always that much difference between the two. So, you should always talk to your accountants about that. But then with Reg A, you've also got state notice filings. The states do not get under Tier 2 of Reg A, which is the one we use. We don't recommend ever using Tier 1, sadly, but Tier 2 is preempted from state regulation. But they do get to get you to pay money for the privilege of offering in their states. So there's a whole bunch of expenses there, somewhere in the range of 12, 13,000. And then you've got the Edgarizing process for Reg CF. You can just do a PDF, and after several false starts filing with the SEC, because Edgar is a very fussy process, that's the SEC's electronic filing system, you can just file a PDF, but you can't do that for Reg A. So you've got to reformat all of your information in HTML. I think it's 6.0 or lower. You've got to sort of dumb it down and then file. So there's a lot more expenses in Reg A.
Yeah, well, one thing, and Sarah did a good job of kind of touching on the legal and mechanical aspects of Reg CF versus Reg A and how a decision is made. Often, in my experience, I often see sort of smaller companies, what you would consider kind of seed capital, considering a Reg CF. The one thing to remember for issuers is I think more so with a Reg CF, but both a Reg CF and a Reg A, you end up with a lot of retail investors, retail accredited investors, non-accredited. You're not going to end up with large kind of institutional shareholders. So from a practical sort of experience and businesses. Kind of depends where you are in your life cycle, how much capital you need, where you are in your business. Are you looking for $500,000, $1 million, maybe 5 million, or are you at a point, sort of a tipping point, and a crucial point where you think a Reg A would be sort of more beneficial for the growth of the business, raising 10, 20, 30, 40, up to $75 million US. So that's also a metric that you need, an issuer does need to consider.
Well, you brought up a good point there when I'm thinking about companies and going into transitioning from a CF to, say, a Reg A. I mean, if I'm doing a CF and I'm raising $5 million, what I'm hearing is, okay, it's easier for me from a filing, from a cost perspective, but I'm almost kind of testing my business in a sense to say, what's the audience appeal? Do I have an investor base and brand advocate base that I might be growing towards? And I'm seeing that this conversation comes up, and we're talking about cannabis in the cannabis industry today, where they say, hey, I've got a base of brand advocates. I've got a product I'm bringing to market, or I'm pre-revenue. So let's start with the ones I've already got a product I'm bringing to market. I'm building up my customer base. And that customer base is small, let's say small investors. Would it be accurate to say I'm giving up less of my company with a larger participatory base than I might be with a large investor pushing me early on? So I'm holding my valuation early by letting people participate that couldn't participate in the past. Would that be fair?
Yeah, I think it would. I mean, one story that we keep hearing from our clients is, I could have gotten institutional investment. I could have got VC money. However, the VCs want to take a third of my company and they want to value it much less, and they want to run my company and they don't know a damn thing about it, and they really don't understand what I'm doing. And that's why I'm going to the crowd. That the counter is, you might give up less of your company, as you say, but you may have overvalued your company, and we do see this a lot in CF and A, where companies are like, yes, we think we are worth this. This is all our comparables, and we think we are just as good as them, and we've got the same base, and then they go out with an optimistic valuation, and then of course, when institutional money comes in, the institution's like, yeah, no, we're not going to value it at that.
So you need that delicate balance is what I'm hearing. You can be optimistic, but not egregious, I suppose.
Yeah. Sorry to jump in there, Peter. One of the other things I have to see, and this is particular to the Canadian side, on the Canadian companies that might be using particularly Reg A or trying to consider a Reg CF, is, a large part of what I do for these issuers, it's an issue that pops up all the time, is we structure them to ensure that they're a foreign private issuer and they don't trip the foreign private issuer test in the 34 Act, because we want to avoid them being U.S. domestic and potentially triggering registration obligations with the SEC. So, and the reason I mention that is a lot of these Canadian issuers, cannabis companies, they have U.S. operations, assets, mind and management might be in the U.S. So, we're always very concerned about how much capital do you actually need? And, because what we want to do is maintain the 50% threshold on the foreign private issuer test. We don't want them going out and doing a Reg A where they end up, bringing on a whole bunch of U.S. investors for excess capital that they don't need, and they've pushed over the 50% threshold of the foreign private issuer test, and now all of a sudden they're U.S. domestic and they have a whole bunch of other problems that they need to worry about.
Okay, so you brought up something that I'm not really familiar with, okay? Because I guess if you're raising capital in the United States, you don't really think that you could be over a certain threshold from a foreign, even though a Reg A offering, I can have investors from anywhere in the world. So can either one of you elaborate a little bit more on that? Because that's new to me.
Yeah, sure. Oh, Sarah, go ahead if you like.
No, I was deferring to you because it's automatically turning into an American company is certainly not what people are expecting. So yeah, please.
Yeah. Go. Yeah. So as background, and I'll try to make it digestible for the audience. So the 34 Act, and both the 33 Act as well, they have a test called the Foreign Private Issuer Test. So, and it's written very oddly. And Sarah, I don't know who wrote the test over there. When they
Not me.
It's terrible. But essentially what it is even if you're organized, an entity that's organized outside of the United States, but if you trip both parts of the test. The first part being 50% or more of your issued and outstanding stock is held by U.S. residents. If you check that box, you move to the second part of the test. And the second part of the test has 3 boxes. And if you check any one of those 3, plus the 50%, you're going to be considered U.S. domestic. So those 3 parts on the second part of the test is, the majority of your executive officers or directors are in the U.S., your business is principally administered from the U.S., or your assets are primarily in the U.S. So if you're a U.S. cannabis company, we see this a lot. Canadian corporate entities that have U.S. operations, right? So they're clearly gonna trip the second part of that test, whether the CEO or CFO is there, whether all the assets are there, it's run from there. They're going to trip the second part of the test all day long. So the trick is on the first part, we don't to cross the 50% threshold. So when they come to us and say, hey, we want to raise capital, it's how much do you need? How many U.S. shareholders do you have? How many non-U.S. shareholders do you have? Because we have to be really attuned to this 50% threshold. Now, there are interesting structures to get around it, multiple voting shares and subordinate voting shares. A lot of the U.S. cannabis companies that actually went public on the Canadian Stock Exchange in the last couple of years have utilized this structure. But as kind of putting a thought into the audience's ear, if you're Canadian and you're looking to raise U.S. capital and you have U.S. operations, or your mind and management is in the U.S. or your assets are primarily in the U.S., you have to be attuned to this issue, because you could become a U.S. domestic issuer and you're going to have a whole host of other problems.
That's a really good point, but I would say, Daniel, and with respect to the horrible definition, and it is, you have to sort of work through it sideways and back to front, and we do use that definition in answering another question with respect to Reg A, which is, as we were saying, Reg A is for Canadian companies and US companies. Reg CF is for US companies only. These days, especially post-pandemic, we have frequently have to decide, okay, so the company is formed in Delaware or in Ontario, but the CFO, who used to live in California, seems to be calling in from the Caribbean somewhere, and it looks like they have outsourced their some of their management functions to somebody who looks like he's in London, and their chief product person, she looks like she's in Mexico, but we can't really tell. And so we sometimes end up talking to a company that we think is Canadian or US. And then we start putting the disclosure together, and we say, okay, where's your address? And I'm like, yeah, you should use my Mexico address. I'm like, oh dear, we are now going to have a very complicated conversation with the SEC. And so one of the requirement is that the principal place of business for Reg A be in the US or Canada. And the SEC's sole guidance on this is where the decision, the direct control and coordination happens. All right, so, how do we decide how that happens? And what we do is we look to the rules that you mentioned in determining whether a company is a US company or not, and say, we'll look for the majority of your board to be in the US. We'll look for the majority of your C-suite, especially CEO and CFO, to be in the US. Otherwise, you're going to have some very uncomfortable conversations with the SEC.
Okay, wow. So what I'm hearing is talk to your lawyers to make sure that the residency or the operation side of things, when it comes to a Reg A, that you're aware of it. I mean, so that you don't run into a problem down the road. I've got a question here from somebody from the audience here is going, what are the regulatory reporting requirements specific to Reg A?
I can start. It's much easier than being a fully reporting company. On an annual basis, you would need audited financial statements, and if you are Canadian, the financial statements can be in IFRS, and this is the same for your initial offering as well, but they still have to be audited in accordance with US auditing standards. The auditing standards between the two countries are very slightly different, but the SEC only takes the US one. So on an annual basis, you file a 1K with audited financial statements. That's usually right about at the end of April. could be the first couple of days of May, depending on weekends and leap years. On a semi-annual basis, you file unaudited, unreviewed financials, but they still have to be in GAAP format. So the same format as you did your annuals in. And then if you do anything important, like fire your auditors or your CFO, you file a current report on Form 1U. Now, of course, I've given those, and the semi-annuals are due if you have a calendar year by the end of September 28th. Adjust accordingly, because some of our Canadian companies have non-calendar year year ends.
Okay, so you're doing your audits anyway, so it's not that onerous. The key is to make sure that you're submitting those.
And filing on time. And one of the things that we are, and I'm sure Daniel's got the same experience, when we get to the beginning of April every year, we round up all of our clients, like, are you ready to file? Yes, of course we are. 3 weeks out, are you ready to file? Well, almost. 2 weeks out, are you ready to file? Well, the accountants are really busy, but probably 1 week out, and everybody's panicking. So if you file late, if you have an offering open, you've got to close that offering, because you cannot be making Reg A offers or sales. Offers either, neither offers, neither sales. Your website has to go dark until you get filed, and then you can start again. But this happens every year. I'm sure Daniel's got the same experience.
Yeah, absolutely. I have my clerks and my associates diarize all of our issuers and start rounding them up, just like Sarah says, and it's the same experience. There's a lot of companies at calendar year end, auditors are busy, depending on where you are in their priority list. We're busy, but it always seems like the filing is always a last minute thing. So the sooner you can get organized, the better. What I will say is, coming off the back of a qualified 1A, your annual report is good. It should be easy from a disclosure perspective, because you have a qualified 1A, you have a good body of disclosure. You can use that to create your annual report update as required. But it's really the auditors you have to chase to make sure that you can get your audited financials done. Because at least in my experience, getting the disclosure done is good, and then you have a good roll forward on an annual basis for the disclosure. So it's really kind of the auditors in that regard.
Okay, I think that's an excellent summary. I mean, I love hearing from the legal side of it, because every time I learn the little things. And it sounds like it's preparation and planning. If you plan properly, it's not that it's that onerous. It's not as, well, certainly not as onerous as a public company when you're doing, your annual filing. So it makes it easier. So the Reg A Plus side of it is it's simpler, but you've got to make sure you're doing your planning. Somebody just made a question. So the term comes up. There's tier 2 and there's tier 1. And from our experience, 99.9% of our recommendations are, why would you do a tier 1? And in part, it's because of blues. But it does have a place. Like it has a unique place. But the term blue sky comes up. And whether you're in the cannabis sector or any sector, can maybe you just touch on that, because it becomes confusing to a lot of people. They say, and they ask us as a tech provider all the time, how do you cover blue sky? And we say, well, our tech can cover anything. It's really what you've done, what exemption that you're dealing with up front is the important thing. So maybe one of you can jump in on that, and the term blue sky and where it fits in on the regulations.
Sure, I'm happy to answer that question. Yeah, so blue sky just really refers to the state securities laws. I mean, your Reg CF or your Reg A is being conducted under the 33 Act, federal securities laws. But I guess what a lot of people miss is that there are state securities regulators, and they do publish their own securities regulations. The major difference between a tier 1 and a tier, so when we refer to blue sky, it's generally state securities laws, right? Blue sky law. So when you hear blue sky, what's that say? What we're referring to are those regulations. So on a tier 1, you have to comply with state securities laws, right? So in addition to doing your Reg A, you'd have to go to each state where you had an investor, find an exemption for the offer and sale of that security, and comply with that exemption, which can make it very difficult if you have a broad investor base coming from a number of different states, which also becomes problematic because the blue sky laws don't always play nicely together on aggregate value or a number of investors in that state over a period. So it does create, it's not as if there are exemptions, there are, but sometimes they don't play well together and it creates all sorts of problems. The Tier 2 Reg A is really nice because while it's exempt from state regulation, having to find blue sky law exemptions, I mean, the states have essentially, created notice filing requirements similar to what you do on a Reg D offering. When you do a Form D, you still have to make your notice filings in the various states where you've made sales. So that's really what blue sky refers to. I hope that's digestible. Sarah, if I've missed anything, you add color, I mean, please go ahead.
Yeah. Now, one thing I would like to add is we frequently have the conversation about, well, I'm looking at the rules for Tier 1 and Tier 2 here, and Tier 1 says you don't need audited financials. Tier 2 says you do. So why would I do Tier 2? And the answer is that's only at the federal level. And as Daniel noticed, there are requirements, different requirements in each state, and many states do require audited financials, and some states require that you can only offer, for example, preferred stock. Some states say you can only offer in our state if you have independent directors, which most of our startup companies can't afford. So they've all got very different rules. And although Washington State did a fantastic job bringing together the whole process to try and make it more effective, it's still hugely burdensome if you're trying to sell a startup in all 50 states and the territories too. Our experience with one specific company is we filed under Tier 1 because the company didn't want to do ongoing reporting. And so we had that conversation with, okay, we've got to go through all of the states. We filed with the states through the coordinated process that Washington runs. We got 100 comments. There was the merit-related comments, and that's the states that determine whether an investment is good or not. Then we had the disclosure-related comments. Those are the states who decide you can sell if you just tell, you give all of the information to make an informed decision. We got 100 comments through that process, and then we had additional comments from a whole bunch of states. We answered them. We appointed independent directors as requested by one state. We were told by 3 states, you're never going to get through here. And they were 3 of the biggest ones. We refiled. We got another 100 comments. At this point, the company is like, we're never doing this again. We withdrew from Tier 1. We filed Tier 2. We got 7 comments. And the rest is history. I mean, we would charge danger money if we ever did a Tier 1 offering again. It's good, I think, for real estate companies. If you're a non-startup selling in a limited number of states and you have actual assets, it might make sense in those circumstances. But otherwise, for most companies, it's going to be Tier 2.
And that's what I was thinking. If it's very isolated states, very specific, you almost know your investor community on the back of your hand. But then it's fair to say, if you were looking at doing a Tier 1, at the end of the day, it's going to probably cost you more and delay everything than a Reg A Tier 1, and you can raise more capital. You just got to do a little bit more preparation up front. Is that what I'm hearing from both of you?
Tier 1's going to cost more, especially if you use us. It definitely will.
Daniel, you're same. That's
no,
that's the high level advice we give to people. Say, don't do a Tier 1 unless you've got a space.
I 100% agree. And the funny tension is, the Jobs Act and when they revamped Regulation A was all about access to capital for smaller companies and it's streamlined. But on a Tier 1, the states just make it far more difficult, right? And to be quite frank, if you were looking at a Reg A Tier 1, I mean, like as Sarah points out, real estate companies, or you have a strong investor base or story in a jurisdiction or a state, makes it easy to get a blue sky exemption. But then to that point, why are we doing a Reg A Tier 1? You might be better off just doing a straight Reg D private placement, right? Because you're likely not public.
If you knew them, yeah.
And if you have access to capital, then there's no reason for it.
Okay. Cannabis. We're here. The week's about cannabis. So what's your experience when it comes to things like comments? What advice can you give cannabis related companies. And there's a big difference between the sector when it comes to, I hear the term touching the plant. We don't touch the plant, or we do touch the plant, or we're the manufacturer, or we're the plumbing pipe fitter guys, or we're the new irrigation system guys. Can you share some color specific to that when it comes to no comments, or I'll turn it over to you.
Well, from the SEC's point of view, I mean, what they're looking for is just tell us who regulates you and how you are regulated and how do you need to comply with that, and then also throw in your risk factors, which of course for US companies is we can't do banking because it's still illegal at a federal level. So long as you have the sort of standardized risk factors and the standardized disclosure, that's sort of gotten a lot easier for US companies. I'm not sure if we've done any cannabis companies, but it's the specificity of we touch the plant, therefore this, or we don't touch the plant and therefore this. The tricky bit that we've come across is state regulation of cannabis. So if you are incorporated in Oklahoma, for example, there are all of these rules about who can own, who can control, who can transfer. And so one thing that we have noticed with Reg A in recent years especially is that the staff is paying a great deal of attention to what's in the company's bylaws or operating agreement and how you describe it, and making sure that this is described properly so that people understand by reason of investing in this company, I am now, for example, not allowed to invest in another cannabis company in the same state or a different state, or I can't have more than X% of another cannabis company. And they want that really explicitly written out because, like I say, on the US side, it can be completely different from state to state. And despite the fact that at a federal level, Reg A securities are completely free trading. You could sell them if you could find a market for them. And Reg CF are free trading after a year.
Mm-hmm.
But that's all gone by the book if you have an operating agreement that says you can only resell under the following circumstances, and you can't sell to felons, and you can't sell more than 5%. So you have to be very careful about that aspect of regulation being properly described.
Yeah, I agree with Sarah. My experience and the way I explain the SEC, and whether it's an S1 or an F1 or an S4 or 1A, depending on what we're doing, is I liken the SEC they're a consumer protection agency, right? What they want is disclosure. They're not here to tell you how to run your business as long as you're not doing anything obviously illegal. So Sarah's quite right? We touch the plant. We've got FDA issues, maybe Health Canada, we're a pharma company where we have a process, we're developing something, a molecule, something with THC. As long as you're giving all of the investors all of the information that they need to make an informed decision, I think typically that's all the SEC wants to see. And to Sarah's point, I think they are paying attention. What is in your bylaws? What is in the state laws? Do these things mesh? Are you also telling investors, as Sarah's pointed out, if you invest in us, you're going to have problems here. You can't do this. You can't do that. You might not be able to cross the border. That's another risk factor we see all the times for officers and directors. So as long as the information is there, I think of it as a consumer protection agency, and that's how I encourage clients to think about it. Let's get the full picture, the full story out, so that doesn't look like anything's being omitted and anything's being hidden, and everything's plain for investors to see and make an informed decision.
I love how you put that, consumer protection. And I think if we take it from that light, then we're not as jaded by the regulations aren't meant to stop the raising capital. The regulations are there, whether we like them or not, or how we like them, or how confusing they may or not be. If we follow them, these are the best regulations on the planet, as far as I'm concerned, for private companies to raise capital. Just do it properly. And having conversations with people like yourself. And part of what we love to do at CORE is that educational component, because what was going on yesterday isn't necessarily what's going to be going on tomorrow. In the cannabis, go ahead.
I was going to say one thing. It's just a thought that popped in my head. So when we're speaking about the SEC and what does it mean to be a cannabis company, again, I think Sarah and I are in agreement. As long as there's disclosure, we don't have an issue. I think where you're a company and you have sort of intentions or aspirations of whether it's the OTC, NYSE, or NASDAQ down the road. I think that's really where being a cannabis company, it's not problematic, but I think where you kind of push up against more speed bumps, because you might have to get a 211 through FINRA. You might need to get DTC eligible, and being in the cannabis industry, may create problems there, as well as an exchange may exercise discretion not to list you because they don't like the sort of industry or what you're doing, or the fact that you're in cannabis. Look, there's lots of cannabis companies listed on NASDAQ. I've done a bunch of them. But I think where the tension would occur would be there.
Yeah. And also one thing that we have noticed is the other service providers. There are banks who will not touch either all cannabis companies or cannabis companies that do touch the plant. And so that is a sort of logistical issue. You're going to have problems with banks if you're a cannabis company anyway, but now you've got problems with banks not wanting to be your escrow agent as well.
Yeah, and do you think some of that's, I guess the reason doesn't really matter. Some of it could be simply a large bank from an escrow perspective. It could be optics. It's, hey, they're not touching the plan. I'm selling securities, but it's easier to do nothing and to not get engaged with the sector because, well, in one particular state, cannabis is illegal completely, and and I have bank offices and all of that. Do you think that just the optics side of it makes it more challenging from a banking rail perspective?
I think really, it's a compliance thing, right? Like cannabis is still illegal federally and scheduled. And I don't think the banks can really want to touch it, given the fact that, despite the Cole memo and despite what's going on at the state level, right, we still have it scheduled federally, which makes it illegal. I also think there's AML issues for the bank, given the sort of fractured nature of cannabis and where money's coming from. So I think that's really, and then banks are just conservative by nature, right? Like the big banks are not the ones out there opening crypto trading accounts, doing things, right? And they're also conservative by nature. So I think that's really what it is. Sarah, I don't know whether you agree or have.
Yeah, no, totally agree.
Well, I also think there's a great opportunity for those forward-thinking smaller banks that are tech savvy, that at the same time are looking into the category, because we certainly know, especially with the recent announcements with the U.S. government's, with the Biden administration anyway, making certain comments, what happens. We know it's a growing sector. We know that the cannabis industry is going to continue to grow. And if these regulations were there to help democratize capital, to make it easier, take away the friction points, for private companies, small companies to raise capital, I'm pretty optimistic about it. But you've got to do it right. The term "no comments" gets bantered around, and we do a lot of raises all the time. So we hear these. We're waiting for companies to use the tech and jump on board, and they're going, "I'm waiting back from." Oh, I've got a few more comments, and I do hear it more so in the cannabis sector than other sectors. Can you give any advice when it comes to that? Is it just lack of disclosure? What's an example of like of comments that come back from the SEC that are delaying their qualification?
I think from our point of view, it's usually, if it's a cannabis company, it's usually those tricky state things. Do you have the right risk factors? Are you describing your regulatory situation properly? And do you have any inconsistency between state law, your constitutive documents, and your disclosure? Okay. But yeah, I think probably, just to sort of go back on what you said, Peter, in some cases, the SEC will decline to review an offering. We saw that a lot during the SPAC era. We are not seeing that so much anymore. I think they've got more time for reviewing these days. But I don't think we ever saw no comments on a cannabis company. Daniel, did you?
No, I've never seen a no comment on a cannabis company. But what I will say is, look, the regulators are often reactionary to what the markets and deal people are doing, right? And so when cannabis first became a thing, and there's a psychedelic craze, lots of people are doing mushroom deals now, whether they're touching the mushroom or doing novel kind of molecules based off it. But the point is that the deal guys in the market are always kind of ahead of the regulators. So when we first saw cannabis come through, I mean, the comments you would get were insane. They were long, they were detailed, and that's because the regulators were kind of catching up to the kind of the wave, the industry, right? And so now what we see is we know how to approach the regulators. We know how to draft the disclosure. We know the risk factors for the most part. So while we don't get no comments on cannabis issuers, we certainly do get kind of, I would say, kind of predictable comments, and we're better able to deal with them because it's been a few years now, right? And so the regulators have caught up and they're there, and so there is kind of a formula back and forth, and the comment letters are much shorter.
Got to have a comment here from budgetary requirements. Big question everybody wants to know is like, okay, I want to do a Reg CF or I want to do a Reg A plus. From a planning perspective, from just from the legal side of it, not the audit side of it, what's some good ballpark statements that you guys would make? You do it all the time. I know you guys are extremely cost effective in what you do, but people have to budget. So what insights or what quantifiable numbers can you provide to the audience here?
Well, I can give you ours because that's a matter of public record. It's in all of the Reg A filings we do. We charge $60,000, whether it's cannabis company or something else.
Yeah, so I often say to issuers, look, if you're doing a Reg A, where do you want it to be? Do you want us to do all the drafting, or do you want to take the first cut? Because that's where you're going to have cost, right? If we have to get a data room and get up to speed on your business and draft it, it's going to be more expensive. We're based in Toronto in Canada, so we bill in Canadian dollars. So, we normally see a Reg A somewhere between 50 Canadian to 70 Canadian, depending on where we fall in that spectrum of, are we doing the first cut or are they doing the first cut?
Okay, so pretty similar.
But, sorry, one thing to point out, Sarah, I don't know, like on the fees, that's just legal fees, right? Remember, you're going to have audit fees. You're going to have to engage a transfer agent. There's a bunch of other fees. So don't take that.
I'm just doing very, very high level by all means. I mean, it's a bit of, each case is different. How long is a piece of string within reason? But so budget in that 60K range. That's kind of what I'm hearing here. Would that be fair? Just as planning. Could be a little bit higher, could be a little bit lower, but in most cases you have to budget those kinds of numbers. And then you've got your audits. How long is a piece of string? Are you a new company, or how complex, how complicated a company? How established are you? Sarah, you had
the one thing, and I'm seeing one of the comments come in here. I mean, I would say when you're budgeting, you should also have in your budget ongoing reporting costs, because you will have to pay legal fees and auditing fees for them. And to answer one of the questions there about ongoing reporting, and some people don't want to become ongoing reporting companies, even though, as we discussed, it's really not that burdensome if you are an organized company. You could certainly be a company that does either goes tier 1. I'm not recommending that, because I'm not going to do that again. That was too painful. Or you could structure your offerings such that you take advantage of the fact that if you have less than 300 shareholders of record, which includes, if you've got a custody structure and the like, you can do the one and done structure. So you file 1K, and because your shareholders are all held through a custodian, you've only got one shareholder of record, and that's it. You can then withdraw from the system. I'm not sure I like that, because I'm a public markets person. I like transparency, but you can do that.
Okay, thank you for that. Daniel, any closing comments, recommendations specific to preparation, I guess, from a filing perspective to the cannabis sector at large? I know this touches on everybody, but past experience, don't do this or do this.
Well, I think you have to be organized if you're looking to do a Reg A. Particularly, I think a Reg CF is a little easier. But if you're going to do a raise, Reg CF or Reg A, get organized, get ahead of it. Certainly from a bookkeeping perspective, have your books together, right? Because the big thing is auditing as well. Your auditors are going to need good journals, good books, good P&L to make sure that they can prepare your audited statements. Get in contact with the lawyer, Sarah, myself, or anyone else if you're choosing. make sure they know what they're doing, make sure they're organized, make sure they've been through it before. It'll make the process easier for you. But I think with anything in life, organization and get ahead of it. Don't call us, a week before saying, hey, we need to do a Reg A, because it doesn't work that way. And if you want it done correctly, you need to give yourself time to organize and get it done properly.
Well, thank you for that. It takes a team and the experts in their various sectors, whether it's the marketing, whether it's the legal, whether it's the technology. Those that live in their lane get good at what they do. That's why I respectfully, strongly recommend the Daniel Nauths and the Sara Hanks of the world, because they do a great job and they do it all day. So they can experience, I keep saying, I'm not going to my brother Ken, the potential lawyer, to say, would you do my Reg A filing for me? I just would never recommend that. So those that do it all the time, and things are always changing. So on that note, thank you very, very much. And I think the cannabis sector has a great continues to be a promising sector to raise capital. And hopefully we shared some good insights with our audience today in that regard. And both of you, I want to commend you and thank you always. Every time I learn something new, it's just every little tidbit here. So it sounds like Reg CF or Reg A's, they work for both audiences, provided you do the planning, do the measurements, and talk to the right partners in advance. So on that note, again, we're at the top of the hour. Thank you so very much for attending and being part of the panel today.
Thank you, Bob. Thank you, Peter.
Thank you.
All right. Have a great day. Bye-bye.